We all know Warren Buffett is known as one of the best investors of all time, but his right-hand man is Charlie Munger. And Charlie said something really interesting the other day. He said, "It is a tragic mistake to sit on the sidelines in cash, waiting for an inevitable market correction. To overcome this, it's necessary to become experientially aware of volatility, which not only should, but will happen." So what is he saying? It's a mistake to have cash and wait on the sidelines by not investing. And to overcome it, you need to be aware that market volatility is going to happen. My name is Zach, the Money Nutritionist, and today we're going to talk about market timing and the coronavirus. From deep in my soul. So I know what you're thinking. What does Charlie Munger have to do with coronavirus? And I'm going to get to that in just a second. Before I do, you need to understand market timing. The quickest way to explain market timing is basically trying to estimate when you should buy stock when it's low and knowing exactly when you should sell it when it's at its highest peak. So people try to time the market in saying, I know these stocks are as high as they're going to go right now, so I'm going to sell and make a profit. And then I'm going to wait till they go back down and I'm going to buy those stocks really cheap when I know they're down, and I'm going to wait till they go back up again and try to sell them when they're high again. That's essentially market timing, and many people will say it's nearly impossible to do. So now that we know what market timing is, and unless you've been living under a rock, you also know what coronavirus is. Coronavirus is a flu-like virus that is spreading around the world, killing thousands of people at this point. The coronavirus is most deadly to people over 80 and people with pre-existing health conditions, and it's 96% active in China. But that's not to say it will slowly start spreading to other places, because as we've seen, it is starting to do that. The coronavirus is actually potentially the worst contagion since the Spanish flu in 1918. We also know that China makes up 1/3 of global trade. And now that 96% of the cases of coronavirus are in China, you can see why the effects will start to affect economies. When people get afraid, the markets start to take a hit. And we've been through this before with things like the fear of recession over the past, 5-6 years now. We also faced it when we thought there was going to be a nuclear war between us and North Korea. Now, the Wall Street Journal advises people not to panic, even though they also stated that the Chinese economy should contract by 10% over the next quarter. But the Wall Street Journal also pointed out the fact that the U.S. economy has a sturdy foundation now. We have low unemployment. We have wages that are actually rising. Interest rates are still low. So even with that happening in China and their economy potentially constricting a bit, we should still be okay, according to the Wall Street Journal. But one more thing to realize, there is an election this year, so things will become highly politicized and blown up in the news and media, as it always is, and that's also going to play a part in the market. So we have all these factors that we now know about between China and people's beliefs and the US economy that could potentially impact the market. So we know that. Now, where does coronavirus come into play here? So about a week ago on February 25th, the US Center for Disease Control released a statement saying that you needed to steer clear of people that you thought could have flu-like symptoms. You needed to see your doctor if you started having these symptoms. You needed to try to avoid people that had been to China. So they released statements on how you could reduce your risk for contracting the coronavirus. They also pointed out that 96% of the cases are in China. There are now a few cases in Washington state, and that men are actually more likely to contract it as well. So what happens is people start to freak out when these diseases start spreading around the world. And they have every right to do that. And the impact on the stock market is that it becomes very volatile. And with that volatility and the continued spread of the coronavirus and it being a political election year, we could most likely foresee continued volatility in the stock market. So with this continued volatility, there are 5 things that you need to know from our good friend, Charlie Munger. Number 1, there are fewer bargains in the stock market now than there were in, say, Nifty 50 or the tech bubble of 1990s. So the point is that the companies we have now are more valuable than the companies were in the last booms and busts, as we will call it. What that means is that stocks aren't as cheap, there aren't as many bargains as there were in, say, the tech bubble crash of the 1990s, but that's because our companies are more valuable now. And that's good for you because the companies are more sustainable. The second thing you need to know when it comes to the stock market right now is that the old moats of protection don't quite exist like they used to. What I mean is that the tactics of value investing have now changed to where you could just blindly buy stock that was at a bargain and you would expect it to grow over time. But now that's not the case. Because the key is that you have to understand the underlying business. For those of you who don't know what value investing is, think of it as shopping. You would go to the store and there is a TV that is priced at $1,000, right? It's a nice 4K OLED screen TV. Well, the economy goes through a bad time and that TV is now discounted for $400. What are you gonna do? I'm probably gonna go buy that TV because it's at a discount, right? And then you're happy and you have your TV. Well, that's the same thing with stocks. Value investing is essentially waiting for a stock to go down in value. So if, I don't know, Apple or Tesla or anything like that drops, 200 points, you would say, hey, that stock's at a discount. It's at a value price, so I'm going to buy it. And it used to be that you could do that knowing that a company would eventually appreciate in value. But that's not so much the case anymore. So that's something else you need to be aware of when you're looking at the stocks you want to buy. The second point goes right along with point number 3. Avoid making big mistakes by investing in companies that are highly priced and have very poor balance sheets that are run by incompetent people. The thing is, how would you ever know that? You would have to do your research. You would have to look at the financials. You would have to look at who's running the company. And this would be more of a fundamental style of investing. This is a very different style of investing where you look at the company, who runs it, what products they sell, what the future looks like. Whereas the other style of investing would be, I'm going to look at the numbers and the charts. Those are two different styles of investing. So the third point is that to avoid those mistakes, you need to understand the inner workings of the business that you're investing in. The number 4 thing that you need to realize right now when it comes to the coronavirus and market timing is you need to recognize when it's time to move on. And you also need to realize when you were wrong. The key takeaway here is sometimes you have to take your losses and put your money somewhere else when you know that the stock's just not going to go back up or the company's going to go bankrupt. The point is, if you own something that's not going back up because things are changing, if autonomous cars start to take over and you own Uber, or if Macy's starts preparing to close down all their stores with no strategy of going online. Once you understand how those businesses work, number 4 will start playing a larger impact in your life. And number 5, just be true to yourself and be authentic. If you don't understand anything about tech, but you bought some stock or want to buy stock because someone else told you to, then you just need to be honest with yourself and say, look, I don't know anything about this business. That's not for me. So be true to who you are. If you're environmentally friendly and that's what you care about, why would you invest in something that's not environmentally friendly? So the big message here is that when it does come to investing, you have to know who you are and you have to be yourself. And as always with investing, you should always have a plan. You should always know where all of your assets, your investments, your debts, and your income currently stands. You should also have your insurance in order. You should have your retirement planning in order. You should also be diversified. And last but not least, you should know your risk. So even with the volatility of the market going up and down, up and down, up and down, knowing your risk and where you've put your money, understanding that if you lose all of it in this area, you're going to be okay because your risk tolerance can handle that, then it shouldn't matter how volatile the market really gets. And that's why the last point of being true to yourself and authentic is so important. So if you haven't noticed, all of this goes to your mindset and thinking in a certain type of way. So I'm going to add a link down below called Magical Thinking. So if you have some time, go check it out. I highly recommend it. So as always, I'm the Money Nutritionist. Thanks for joining me. Please don't forget to subscribe because it really helps out the channel. And I will see you in the next video. Thanks for watching. Be sure to follow me on Twitter, Instagram, and Facebook to stay updated on the latest. But more importantly, to stay updated on YouTube, press the subscribe button below.